forget. Okay, so in our own tutorial group, we have edited slides. Basically, I've edited them for flow of ideas and the presentation. So I encourage you to use the edited slides in the tutorial group instead of the main slides in the lecture group, right? So you can follow. Of course, if you prefer using the one in the main lecture, feel free to do that as well. Okay. Okay, and then these are the core readings. Basically, if you follow the lecture slides, you are pretty good for the exam. But I would like to highlight that the study guide can be important for like your GBA, where you have a group project. Usually, GBAs, they tend to ask a bit tougher questions that might be slightly beyond what's covered. So the study guide will be useful. So far, I've not seen anyone use the textbook, so I'm pretty safe. You don't have to look at the textbook. Of course, if you don't understand any concepts, yeah, the textbook is a good reference. All right, so the usual stuff, let's go through them. In terms of the pre-course quiz, I guess you have time, but remember to do the pre-course quiz. So if I know the school is pretty strict, if you don't do it, you're automatically withdrawn from the course. All right. In terms of TMA, the usual TMA, GBA. So again, I want to remind you to do the to form your GBA groupings by the end of this lesson, right? At the same time, in terms of class participation, so usually I like to be very upfront. So everyone basically gets 50%. At least, and then basically your participation in class will add up, will add the other 50%, right? And the thing is, I usually encourage, so that the last few years that I've been teaching the course, I usually encourage you to either unmute yourself or you can type in the group chat to either ask questions, clarify any doubts that you have, and that counts for class participation. And I'll say it's very important for you to ask questions, because sometimes that's where you learn the most. And of course, you engage with the material when you participate in class. So feel free to unmute yourself. So you don't have to worry, don't be shy, or of course, type the group chat, that's fine too. All right, so a bit more administrative. I'll be using Excel. So if you are a repeat student, like from 2 years ago or maybe 2 semesters ago, usually the professors use the financial calculator, but now we've just used Excel all the way. So it's simpler. Everyone has Excel, so you don't have to buy a calculator. Of course, if you want to use a financial calculator, that's fine too, but we'll not go through the steps in class. Yeah, but you can ask me if you have an issue with the financial calculator, feel free to just private message me, because I'm pretty familiar with the financial calculator, because that was what we used previously when Excel wasn't allowed for exams. All right. Okay, maybe before we start on this, do you have any questions, any concerns?
Hi, Drew.
Hi.
We need to have financial calculator?
No, so we don't need. So you can use Excel all the way, and I'll be teaching using Excel.
Okay, thank you.
Yeah. But if you prefer the financial calculator, you can use the financial calculator. Just that I'll not go through the steps. When I taught 2 semesters ago, this same course, I taught the financial calculator steps. But then after that, the school's stand was that we should just focus on Excel, because everyone has Excel, and so the students need not buy a financial calculator. So I've converted all the slides into Excel explanation. Okay. All right. Yeah, I think. Oh yes. So normally I like to how I actually go through the lesson is I like to give you like the broad idea of what you're doing first, like the intuition behind what you're studying, before we go into the details. Because sometimes I feel like when we tackle all the details, you get a bit lost. Like, okay, so why are you doing so many steps? So usually I like to give a broad picture, and that's usually how I teach. At the same time, usually we'll do 2 breaks. So every hour we'll try to do like a short, maybe 7 minutes break, 8 minutes break counting. So we can have a bit more rest in between. And sometimes it can be too much information, right? And the course can be a bit demanding at a later part. So we'll do that, right? Hope everyone's okay with the 2 breaks, yeah? Okay, so, as usual, feel free to unmute yourself, like what your friend did if you have any questions. Let's just kickstart the lecture. If there are certain parts that go very fast, it means that they're not so important. For example, like all these introduction slides are not so important, so I try not to focus too much time on that, right? So you can just simply read through. All right, so let's talk about finance, since I think we have a mix of maybe mostly non-finance majors. So let's just talk about some things about finance, right? Why do we study finance? There are various reasons. There's marketing, accounting, management, and personal finance. Of course, what we're focusing on in this entire lecture or entire module is more on the, I guess, like the management. That's why it's called financial management. And finance is quite different from accounting in the sense that we need accounting knowledge, but finance, it's really more real life kind of calculations or modeling or things. But accounting is more historical. So that's the difference between accounting and finance. Accounting is purely, I would say, historical. Nowadays, there's a bit more like present value or like current value, market value kind of accounting. But normally, for 90%, 80% of the time, it's still pretty historical, right? Let me just pull out my pen so that we can annotate some stuff. Okay, so basic area of finance, we have investments, financial institutions, and corporate finance, which is what we're focusing on. I'm not sure whether any of y'all are reading the news or are interested in finance news. Financial institutions has been in the news yesterday and today. Anyone know about the Credit Suisse issue? Yeah, okay. I guess some people are into the news. Yeah, so for the benefit of everybody, Credit Suisse is being taken over by UBS. So 2 of the largest Swiss banks, right? So Credit Suisse, but both banks in Asia largely deal with wealth management and not retail banking. So you will not see them on day-to-day basis. Maybe if you are a high net worth individual, yeah, you might bank with Credit Suisse or UBS. But anyway, so there was a takeover and it's a major news in the market. So that's a financial institution. Of course, what we're focusing on is corporate finance and more on the business, because FI or banks are very different in terms of how we calculate finance and all details from there, right? Okay, so in terms of investments, this is just an overview, but what I would like to highlight is that we'll talk about stocks and bonds. We'll talk about how we calculate them. I believe in the next lecture, we'll see how we calculate the value of a stock or how do we value a bond. What's interesting for the bond here is that now interest rates are going very high. Interest rates are quite crazy now. And if you have a bit of finance knowledge, anyone know what will happen to the bond price? Bond price when interest rate increase? I guess not so. Yeah, go down. Okay, yeah, some people know. Yeah, go down. Yeah, so interest rate is inversely proportionate to bond price. So if you are holding a bond maybe 3 years ago and you're holding it for 10 years, basically your bond is being written off now. Write off meaning that it has no value because the interest rates has been going very high, right? So we'll look at that. We'll talk about some things about bond. We'll talk about some characteristics. But what I'd like to highlight more important is the risk versus return. So, after taking this course, and hopefully there's anything that you should learn from this course is that whenever we think about the investment, we need to consider both risk and return. So maybe a person in life science or let's say engineering, right? If they think about investment, think about finance, people usually just look at the rewards. What's the return? Maybe 30% return. Oh, that's so good, right? But as a finance or as a management graduate, so management meaning you can be from any other specialization, but at least you take one or at least two courses of finance, we should know that risk and returns are very closely related, or in fact, they're related to each other. And we need to consider both the risk and the return whenever we think about investments and not just the return, right? And so we will use to calculate the risk. We'll learn how to calculate risk as well. And yeah, that's a good question, whether it's inversely related. It is actually not. It gets a bit complex on how risk and returns are related. So we'll look at it. That's a good question. We'll look at how they are being related because we'll see that we need to consider various functions. I'm not sure if you recall what correlation or covariance. So I believe all of you have taken a basic statistic course, right? So yeah, we have taken basic statistics. So there is a correlation, there's covariance that we need to consider in risk. And in terms of return, we need to consider this thing called beta, right? Which we will talk about in detail. So not to worry. All right, financial institutions. So these are your banks, your insurance company, etc. So nothing too much to talk about. They basically specialize in finance matters. And this is the part that we are interested in. So in the course, as I mentioned, this is just an introduction. We'll talk about whether the firm should take a long-term investment. So how do we evaluate that the long-term investment is a viable option for the firm? All right, and we'll talk about some long-term financing, how and what kind of financing the firm would get or should get. And at the same time, we also mention some everyday financing activity. And I would like to mention this, which we'll actually cover today, this thing called working capital, WC. So we'll understand what is working capital and how it actually affects the everyday activity of the firm. All right. So there are various decisions that we have to make under this broad umbrella financial management. So capital budgeting, we have I just mentioned earlier, is about whether we should take a project, whether this project is profitable. So we need to think about how do we determine the profitability of the project, right? Now, capital structure. So I would like to put this as usually bonds and stocks. So stocks are equity, right? So there's EQ, stocks are equity, bonds are considered debts. So basically, we are looking at both the debt and equity structure of the firm. Of course, there is this thing called P stocks, which is preferred stocks, and these are important considerations as well because preferred stocks, they are a very unique kind of shareholders. So we will need to consider preferred stocks as well. And for day-to-day financing, we mentioned already working capital here. WC. All right. Okay. So for this part on forms of business organization, it's purely for you all to read. I'll not really go through it because I believe you have covered this, and they're not very critical, I would say, for the course. I'll just highlight some important points, okay? Of course, as usual, if you have any questions, feel free to just type in the group chat or even unmute yourself regarding this business. organization. So proprietor, it's basically one person. The main issue is about raising capital. So equity is limited, right? And of course, it's unlimited liability, and it's limited in terms of it's being tagged to the owner's life, right? So that's sole proprietor. Now, partnership basically is one or two or more people, actually, two or more people. We have this thing called the unlimited liability partnership, which is not so common now because most partnerships are limited liability. And the difference is the limited liability basically restrict the amount of liability to the liability of the partnership. And so if in any case there is like a claim, the person claiming cannot claim on the partner's wealth, right? So that this means it's limited liability. Of course, there is unlimited liability as well. Unlimited liability means it's just a general partnership, a normal partnership, right? And this is the general partnership that we're talking about. So if there was a claim, the person claiming can claim on the partner's wealth, right? So this is not too common nowadays since limited liabilities partnerships are available. Of course, the most difficult part about partnership is that it's difficult to transfer its ownership. And at the end of the day, what we're focusing on this course is corporations. And for corporations, it's very easy to transfer ownership, right? So imagine you go on the stock market, you buy like one share of Keppel, one Keppel share, right? Basically, you are already an owner of Keppel, and it's so easy, right? You can just do it anytime. This is probably not related to the cost, but for example, if you buy one Keppel share on Moomoo, I believe some of y'all might know Moomoo, which is like this platform where you can buy like stocks and stuff. Do you actually own the share? Anyone knows about this? Anyone that's doing investment now? Let's say you buy a share on Moomoo or can't remember what's the other platform. That was quite popular, and then you get like free Apple share when you invest. Anyone knows whether you own the share if you buy it from such platforms? No? Okay, yeah. So you guys know, yeah. So no, yeah, you don't own the share. Yes, that's right. So the broker basically owns the share. So yeah, correct. So the ownership of the share is attached to the broker, and the broker basically pass you the returns after deducting various fees, right? So this is not investment cost, but and if you're interested, I do teach us investment costs as well. But if you really want to hold or own a share, it's better to buy it directly from a stock exchange, right, through a bank. So yeah, anyway, that's a sidetrack. And the thing about corporations, because anyone can own the share, right? If you just buy it from the stock exchange or even a broker buying the share, right? There is this big issue of agency problem. And this is a very important issue. So I'll go into detail, I believe, in the next 2 slides. And hopefully you have some maybe queries or doubts, and I'm happy to address them, right? Of course, one of the issue is also on double taxation, meaning the corporation will be taxed at the corporate rate. And let's say if you get a salary, I think some of you all are already working, then you'll be taxed, your salary will be taxed at the income, right? Your personal income tax rate. So there's double taxation that is happening here. All right, and so the advantages are as seen like this, right? Okay, so this is an important concept, right? What is the goal of the corporation? So out of the bat, I would like to say that the goal is to maximize the current share value per share, all right, of the existing stocks. anyone knows what is the difference between maximizing market share and maximizing the value of the share? So what's the difference? Market share and value of the share. Or are they the same thing actually? Okay, not really. That's a good try. Not really. Okay, so this is a very important part. So if it's important, I'll highlight to you. And maybe if you are using an iPad or even physical notes, do put a star there, right? This is important concept. Why? Okay, so market share is totally different from share price or value of the share, right? So market share basically is how much of the market do you own. So I like to give this example. For example, we have supermarkets, right, in Singapore. We have fair price and let's say cold storage. So which entity has higher market share? Cold storage or share price? Fair price, precisely. That's right. So fair price has a larger presence in the market, right? It has more stores. It serves more consumers, you and me, compared to cold storage. Cold storage is, very specifically in like certain CBD areas or maybe certain areas in Singapore, right? So that is market share. Now, share price is the price on the stock market, right? The price of the share on the stock market. Okay, so the goal of corporations is actually relating to the share price, not market share, right? So if there's a question, whether is it TMA or even your exam, right? Read the question carefully. So market share and share price are very different, all right? So you need to be able to explain what is market share, and market share relates to how much of the market you own or you serve as a company, right? And the thing about, okay, so we know that we want to increase, the goal is to increase current value per share or the share price, right? But does that mean maximizing profit and minimizing costs? The short answer is no. So you have to be very careful as well when we say, oh, we want to maximize the price of the share, but it does not mean that you want to maximize profit and minimize costs. Even though it might be intuitive, like, yes, okay, you maximize profit means that your share price should increase, right? But no, because remember, the value of the share is affected by many things, right? It's affected by the market, it's affected by the long-term, let's say, projects that the company have. Maybe they have R&D projects, right? Or even sometimes there are intangible like items on the balance sheet that is not reflected. And it doesn't mean that we should remove the cost related to these intangibles, right? So there are a lot of factors affecting the share price. So, sometimes might have a misconception that, oh, in order to increase share price, we should maximize profit and minimize costs. Yes, it could increase the share price, but it is not the only way. So again, these are very traditional goals of corporations. What's important is that if you want to evaluate, sometimes if you flip through like past exams, they ask you, okay, evaluate the goal of like a corporation. So it's important to bring forth concepts of, so this is the traditional goal. I'll put as a traditional goal. So it's traditional goal, but the non-traditional goal nowadays, and I believe most of you have some concept on this, is on ESG, right? So we need to consider more things other than just the share price here. We need to consider, the environment, the social governance. And so it's important whenever we think about evaluating the goal of the corporation, especially in the current context, to talk about, what are some ESG criteria that we need to consider, right? We need to consider environment. We're not just talking about maximizing the share price, right? We need to think about, oh, are our initiatives actually impacting the environment negatively, right? Are our suppliers, kind of using, let's say, child labor or minimum wage for the factory workers, right? So we need to consider all these other conditions and variations when thinking about the goal of a corporation nowadays. Okay, so this is an important thing to think about when you consider goals of corporation. So there are various ways in order to maximize the owner's wealth. So we know that we talk about outsourcing. So outsourcing, it's about, let's say you have a US company and they want to outsource their production, which is very common, even like for your iPhones, right? It's all outsourced into China. So that's outsourcing. Offshoring is, to shift certain factories. Let's say in the US, they used to produce the cars, right? They I think like Ford cars. So the thing is, nowadays they like to offshore it to Mexico, simply because labor is cheaper. People are, I guess, still skilled, right? And it's the close proximity to the US, right? Mexico being just across the border, makes it very easy to deliver the cars to the US, rather than for them to offshore the production, let's say to China, right? Yeah, you can do that. But it might be even cheaper, but the transportation of the cars across the ocean might actually add the cost. So rather than outsourcing the entire production, we offshore it to a different country. So generally, if you do a bit more Googling about these two concepts, outsourcing is usually to get someone else to do it for you. Offshoring means that you are still doing it yourself, but just that you change the geographical location, let's say, of your production, right? So again, it's important to distinguish what's the difference between offshore and outsource. And at the same time, there's this corporate support for charity. There's a lot of discussion about this. Why do corporations support charity? Maybe just out of curiosity, anyone knows? Like maybe you can give 1 or 2 reasons why do corporations want to donate to charity? Is there some? Yeah, okay, that's good. Tax rebate, yeah. Yeah, okay. Yeah, okay. So tax rebate, that's, yeah. You're thinking as a finance student, that's right. Tax rebate. Yeah, corporate image, CSR, yeah, PR. So a bit more like reputation, right? Yeah, reputation of the company and all. So yes, you're perfectly right. So yes, those are some reasons. What's interesting is that there's this thing called insurance. Of course, everyone knows insurance, but why? How some corporations frame the idea of donating is that by donating to charities, they basically get insurance when they do, let's say, bad stuff. Bad stuff meaning like they pollute the environment. So donating to charity almost, or what researchers found, is almost akin to like an insurance policy. So because you donate to charity, when you do something bad, people do not think you're that bad, right? They think like, oh yeah, it's fine. Okay, he actually support, the let's say, I don't know, the what's that, reforestation efforts. Let's say, yeah, even though he deforests other places, right, of the, like, let's say, Amazon rainforest. So it's almost like an insurance kind of policy that's happening here. Yeah, and there's intangibles like what I say, so like reputation, right? Reputation risk. Okay, so agency problem. Now this is I put like two big stars here because this is an important concept to understand. And as usual, if you have any questions, feel free to stop me. The thing about agency problem is that we understand that a corporation is owned by shareholders, right? And shareholders can be you and me. You just buy one share, you are a shareholder. But the corporation is being run by managers. And generally, the shareholders kind of hire the managers or vote which manager to be in. And when we talk about manager, we are talking about things like the CEO, CFO, right? So top management. And so usually the shareholders or the board, maybe they have some empowerment for which, like let's say, CEO to employ. All right. And so because our shareholder like you and me, and the managers are obviously two different sets of people, there might be different or conflicting interests. So, for example, if we take the traditional view of a corporation, this would be to increase the stock price, right? So some of you all might already be working, and we know that if you are just an employee, for you, you don't even care about the stock price. Let's say if you are working in, a listed company like Keppel, right? You really care about stock price unless you own some stocks. You don't care about the stock price at all, right? You just care about, let's say, oh, it's the salary, how much salary I get, or the bonus that you get, right? So naturally, you can see that there is already a conflict, right? Like the shareholders want higher stock price, but for you, you only care about your salary or bonus, right? So this results in a conflict, and this conflict is called agency problem. Okay. And so we know that what we want to do is try to reduce this problem, right? We try to align the manager's interests to the stockholders' interests. And this could be in a form of, managerial compensation. And the most basic form usually people think about is like, let's just give the manager some stocks, right? And so he will be interested to increase the value of his stocks. And that's a good option, right? We can give some stocks to the managers. But at the same time, I want to highlight to you, so I'm just going to write here stock options. So this is important because sometimes, questions might ask you, what are like some ways to tackle, agency problem. And stock options is one of the biggest or most used kind of method to tackle agency problem. But intrinsically, these stock options have many issues, all right? And so I'd like to explain them. And of course, you can Google and search all the various like the detailed answers. But I'd like to explain the intuition, the concept of why is stock options bad or not so good. So as most of you, okay, so some of you are year 4, year 3. I'm not sure whether you have taken a derivative course. Basically, derivatives are financial instruments, right? But let me just try to explain to you the thing about these options. So stock options, how it works is that you are given an option. So option is instrument, right? A financial instrument is called option, right? And how it works is that this stock option gives the holder of the stock option the ability to convert the options into stocks when the option hits a certain price. All right, I'm going to repeat again. So the holder of this option would have an ability to convert the options, which is a kind of instrument, into stocks. Okay, when the stock price hit a certain value. So that's how it works. Now, the problem is that as managers, if you are given such a stock option, if I'm interested in just getting a stock, I simply can inflate the share value, right? I do certain things to increase the share value so that I hit the share price and I get the stock. And after I leave the company, all right, I sell the share, I leave the company, and that's all. I get the money, I'm happy. I don't care about the shareholders after I get my stocks. So that's one of the issues with stock option. in terms, we call it myopia, right? Managerial myopia, meaning that the managers only look in the short term. I just want to get my stock options, and after that, I'm just going to leave the company. I get my stock, I sell it, I'm happy. So that's one of the issues, stock options. All right. I would like to highlight the second issue. Okay, so the second issue is stock options, is that sometimes we know that, so sometimes the managers, again, are not given the stock options unless they do certain things. For example, they have a KPI to meet, right? And because of this KPI, managers are, again, short-sighted. They just want to hit the KPI to get these options. So this would cause a misalignment again of the managers and the shareholders, which will cause agency problem. Meaning what? Because usually a shareholder would want the long-term value of the shares to be increasing, right? Because shareholders, they hold the share for what, 3-4 years, or even 10 years, right? They are large shareholders, they might hold for a long time. But as an employee, like some of you who are working, you don't think about working for a company for 10 years, right? Yeah, maybe if you really love the company, you work for 10 years. But nowadays, people work for like 2 years. If you work for 4 years, that's very good already, right? 4 or 5 years, that's super good. But beyond that, I think, we are usually a bit itchy, we want to jump around a bit. Some people, even 1 year, they jump already. So yeah, there's still a misalignment in terms of the time horizon of our engagement, the manager versus the shareholder. So that's important to take note of, right? So again, why I'm covering or why I'm talking so much is that usually if it's important, I think it's critical to discuss more about the issues. Of course, if it's not important, usually I just go pretty fast. Now, corporate control. So corporate control, the perfect case that we have in the market now is Credit Suisse, so CS. So what happened? Now I think now's the perfect time to talk about Credit Suisse. So UBS and Credit Suisse are two big banks in Switzerland. All right. So what happens is that UBS is taking over Credit Suisse. And basically, this is a corporate control. So you are doing a takeover. And when you do a takeover, what happens to the staff in Credit Suisse? They basically, or most of the time, UBS, now as the major shareholder of Credit Suisse, would lay off a good proportion of employees in Credit Suisse, right? For example, Credit Suisse might have a CEO. UBS has a CEO. Do we need 2 CEOs? Right? Since that UBS is already taking Credit Suisse, right? No, we don't need 2 CEOs. So obviously a CEO will be kicked out, right? Or the CFO, right? So there are a lot of, I guess, issues with this, but the threat, so this thing is talking about the threat. So not actual takeover, but the threat of a takeover might force the managers to make sure that the shareholders' interest is being looked after, right? So that's how corporate control can reduce the agency problem for the firm, right? Any questions regarding this before we move on? So I want to highlight the agency problem. It's important for you to really understand the concept and the depth of agency problem. And if you Google it, there are a lot of research articles and things to talk about agency. And if you have the time, it's good to just look through them to understand the concept more. Any questions? Or we are good? Questions were good. Okay. All right. So let's move on to the next part. So that's just a bit like the introduction. The earlier part was not too important about like sole proprietor and all those things, but agency problem is important. All right. So now let's talk about the financial statement. I just want to do a quick check. Does everyone know the basic of like what's a balance sheet, profit and loss, like? Have you all taken like a basic accounting module? Yeah. Okay, very good. Very good. Then at least you have seen what's a balance sheet. So very good. So a balance sheet is as of a certain date, right? Good. Okay, that's good. So balance sheet is as of certain date. We have this basically a balance sheet supposed to balance, right? So assets equals to liability plus owner's equity. That's how I like to remember it. And it's like aloe, right? The aloe vera gel or like a bubble tea thing that you use. So I like to remember it as aloe, so it's easy. Basically, it means asset equals liability plus owner's equity. Owner's equity means equity, like shareholder equity. But that's how I remember it. And so they must balance, right? That's why it's called balance sheet. And yeah, which is written here actually. These things are not so important. We'll move on. So basically, the most important thing is what's a balance sheet, and balance sheet is assets equals liability plus owners. Okay, so this diagram is very good. It shows you the equation of it. So we have our liabilities here. L, this is your OE, owner's equity or shareholder equity, and these are all your assets, right? So you have your current assets and fixed assets. Now, the important thing that for finance especially is this thing called net working capital. And net working capital basically is current assets minus current liabilities. And we'll keep on talking about this throughout the whole course. So today is the introduction, not really introduction, but today we'll talk about what is net working capital. But in the later part of the course, we'll use this concept more and more. So this is important to take note of, right? So CA minus CL. Anyone know what is net working capital, or what does that mean? What is this net working capital? Is it so maybe it's a bit abstract. Okay, so again, I'd like to give you the intuition of what it is, so you just don't memorize the formula. You can memorize CA minus CL, but that's not the point. The point is to understand the meaning of it. So like what okay, so I think some people are getting there: short-term financial health, short-term cash available. You are there, but not really, not too close, because it's CA minus CL, right? You're not only looking at cash. So you are there in the sense that, think about it as this thing called working. So what does working mean? So working means, right, and capital, working cap. So what it means is that what is the amount of, it can be cash, it can be inventory, it can be various things, right? So it can be cash, inventory, stuff, right, that is being used in order for the company to operate on a day-to-day basis. Okay, I'm sorry, but it's actually not liquidity. Again, I repeat, so working capital is the amount of capital that is in the business that is used for the day-to-day like running of the business, that's required for the day-to-day running. That's why it's called working. So the capital is actually working every day. That's how I like to think. The capital is working every day for you. This is unlike other kinds of capital. So some people might have heard of this thing called CapEx, right? Capital expenditure. So capital expenditure is the kind of like, this is related more to fixed assets. So it's the amount of capital that you have spent on fixed assets, right? But working capital is more about the working day-to-day operations of the company. So that's why it's called working. So capital is working for you, right? That's how you remember things, this idea of working capital. Because later part, we'll talk a lot about this working capital, and it gets very abstract. So you have to fall back on what's the intuition. So working capital is simply the kind of capital, and capital includes, cash, inventory, as even accounts receivable that is working for you on a day-to-day basis. Oh, that's a good question. Is net working capital the same as working capital? No, they are not the same. But why do we say net? So we use net, right? Because under so this is a bit more technical, and it's about a bit more accounting technicalities. So the thing is, usually why we say net is because we use net current assets. So net current assets, right, minus net current liabilities. So in this course, we treat it as the same, right? Net working capital and working capital is the same. But if you want to go to the technicality of it, usually we use net current assets minus net current liabilities. Why? Because your current assets, sometimes there is this thing called allowance for doubtful debts. So those are like things that need to be removed from your current assets, right? And so because of that, like things like allowances, we need to net it off. That's why it's net working capital. And again, in this course, because it's not accounting cost, we will not go into details like, we will not be very particular. Oh, it must be net, you must remove allowances and stuff. Because those are, I guess, a bit more advanced accounting. So yes, you can treat it the same here. Net working capital and working capital. And yeah, actually the answer to the standard question is here. So it's the capital used in the day-to-day running of the operations. So it's CA minus CL. Usually it's positive, it's healthy because it means that you have more CA and less CL, right? So more assets than liabilities. Anyone knows when it's negative? When it's negative, is it a good or bad thing? When your net working capital is negative. Okay. I guess the way if you don't want to get if you don't want to take a side, usually people say it depends, right? And actually that is the answer. It depends. So it's not a bad thing if it's negative, and it can be a bad thing when it's negative. Okay, let's think about it as a bad thing first. It's a bad thing because obviously you have more current liabilities than current assets, right? So meaning that when it's negative, the firm will have to get more assets in order for it to be positive again, right? And how do we get assets? Maybe we issue more shares. So when we issue shares, right, we get cash, right, from the people that buy the share. They give you cash. So the company have more cash, then your net working capital will be positive again. So yeah, okay, maybe it's a bad thing because you have more liabilities. Now, it can be a good thing. Why? Imagine again your let me think. Negative. Okay, imagine in a scenario of a restaurant, right? So you have a restaurant, you are in a restaurant, and generally in a restaurant, you have a lot of current liabilities. Okay, why? Because you have suppliers, all right, and your suppliers generally gives you no, okay, this is a not good example because it gets a bit confusing. Okay, let me think about it again. So imagine you have this thing called just-in-time manufacturing. So JIT. So I guess some of you all know just-in-time, or might not have heard it, but just-in-time manufacturing is a way where manufacturing companies manufacture. This was used in Toyota, so it was manufacturing Toyota cars. And the thing is that they only manufacture the cars when a buyer wants to buy the car, all right? And because of that, they generally, when you do a just-in-time, you generally have very low inventory because you don't need to make sure that you have inventory in your warehouse, right? You need not have cars ready made, and because of that, your CA might be very low. Now, your current liabilities might be high. Why? Because you know what? Even in this just-in-time, you still need to buy supplies, right? From a supplier, you still need to pay, accounts payable, or you might take a short-term loan. And because of that, your working capital might be negative because your CA is low, but your CL is still high. That's how it could be. Or one more scenario is that if it's a startup. So a startup generally have a lot of liabilities, right? But the amount of assets they might have is low because they are just starting up. And so they might have a negative net working capital, but it need not means that they are going to fail, they are doing badly. No, it simply means because they are starting up, they are a new company. So yeah, it could be, you know, not bad to have a negative net working capital. Okay. I think there's a question. Payment terms. Yes, so payment terms would affect this thing called the cash conversion cycle, CCC. And we'll talk about this, I think, in the last lecture, and the payment terms will come into play. All right. It might actually affect your net working capital as well indirectly because payment terms allow you to change or increase or decrease your current assets or current liabilities. So yes, it might actually affect it as indirect. All right, so moving on to liquidity. So the thing about liquidity to think about it is how easy is it for you to convert the thing into cash. That's the idea of liquidity. So cash is the most liquid. Let's say inventories are not liquid, right? Why? Because inventories, if you want to convert it to cash immediately, what do you have to do? You have to sell it for sale, right? That's why you have like Big Singapore or like Great Singapore sales, even though nowadays it's not so popular because there's sales every day. But previously, yes, there's the Great Singapore sales because what do they want to do? They want to remove the old stocks, right? Sometimes. So generally, because you want to remove the stocks, you have to give the buyers some sales, some discount, and that's why stocks meaning inventories, are not liquid. So yeah, that is liquidity. That's the idea of what liquidity is. Debt versus equity. So we did mention a bit about it already. So equity is like stocks, right? And your debt, I would like you to understand, it can be a loan, or let's say bonds. So bonds are also debt instruments. So this is an example of a balance sheet. And since all of you have taken basic accounting, I will not really go through. You can just have a look at it. Okay. There's one thing I want to go through on the balance sheet, and this would tap on your past accounting knowledge, and it's important to know. Okay, so this thing called retained earnings, and this is very important. Why? So you need to know this equation for retained earnings, and this taps back to your accounting 101 course, and it's important here. Why? Because we have this equation called ending retained earnings equals to the beginning retained earnings plus net income minus dividends. So does everyone know this equation? This is an important equation. Not really. Oh, okay. Oh, I thought your accounting 101 prof should have mentioned this. So, okay, why is this important? It's because, if you look through previous, exams and all those things, right, for this course, you actually need to know this equation. And I think, and the thing is, we don't usually teach this in the course because we assume that you should have this from your accounting courses. And why is it important is that, for example, if they give you the beginning retained earning for the year, they tell you what is the net income. So if they give you the beginning retained earning, they give you what's net income. And maybe they give you what's the ending retained earnings. You should be able to deduce how much dividend is being given. And for finance, dividend is a very important concept because later we'll see the use of dividends in various formulas, right? And so yeah, okay, so if this is new, please write it down that the ending retained earnings. So what does ending retained earnings mean? So if I'm looking at 2014, right, the value here, 1629. So 1629 is my ending retained earnings. So I'm just going to write it below. 1629 is my ending retained earnings. Now, my beginning retained earnings is this one, 1320, right? Because what is ending in 2013 is the beginning for 2014, right? This, everyone's okay with this, right? What's ending in 2013 is the beginning for 2014, all right? Plus, now, net income figure. So in this sense, they did not tell you what's the net income. I'll just put NI here, minus dividend. So normally, if they give you what is the net income, you should be able to deduce what's dividends, right? So this is how the formula is being used. Okay, yeah, and do write it down because this is an important formula, and I think most of the time, like the professors in this course kind of assume that this was covered in your accounting course. All right, everyone's good. Okay, let's talk about market and book value. Now, book value is the cost of the fixed assets minus the accumulated depreciation. So, for example, you have a vehicle, all right, and every year you need to depreciate it. I believe, yeah, depreciation should be covered in accounting, right? Because this is a very basic concept. So, you know, is depreciated every year, right? Straight line depreciation, accelerated, back accelerated, and all those, right? No. Okay, so that's a good question. Is it same as intrinsic value? No. So book value is different from intrinsic value. Intrinsic value, usually we use this term to refer to the firm's intrinsic value. We don't really say like the vehicle's intrinsic value or the property's intrinsic value. We don't say that. So yeah, intrinsic value relate more to like a firm, like what's the valuation of the firm. Let me say the intrinsic valuation of the firms is something, right? So yeah, that's a good question. So we talk about it as a book value, which is the cost minus the accumulated depreciation. And then this is accounting concept, so ACC, but this is a fin concept, which is finance concept, in the sense that what we are actually interested in finance is not about the book value. Yes, we need to do some adjustments. Later, we'll talk about some adjustments on the book value. But what we're interested in is the market value, because finance is about the market, right? We're talking about stock price. We're talking about what's happening in the bond market. We are talking about, like, you know, Credit Suisse being taken over by UBS. And all these are very current situation, right? We're not thinking about, oh, what is historical last year, which accounting is known of doing, right? What's the last year's profit? Last year's profit is immaterial, inconsequential to me now, when what I'm focusing on is the now, the current. And that's why finance is more, I don't know, it's more important, right? Because we are talking about the current value, the market value. And because market value is what's important to make decisions, right? Book value, okay, so how I like to think about it is, you know, we buy, let's say a HDB or even a condo in Singapore, right? You might buy it for a certain price, right? And that's your book value. But what are we interested in when we sell the condo? It's actually the market value, right? We want to hire, we want to sell it for higher, we want to sell it for profit, right? So when we make decisions to sell your condo or your HDB, are you interested in the book value? Yeah, okay, fine. You need to know that how much you pay at the start. But what you're more interested in is how much can you sell your HDB or condo for, and that will determine your decision to sell. Like, for example, now the market is very good. You know, if you are in the market to sell, you can make a good profit because like prices are crazy, right? So in terms of making decisions, market value is more important, and that's where finance come into play. That's why I guess you take this course, or maybe it's a compulsory course that you can take. But yeah, that's where finance come into place, because market value gives you the decision-making tools. And in the sense of your selling your house, your condo, or HDB, that is what you're going to do. That's what's going to determine whether you're going to sell it. So it's important. So market value is more important for finance. Right. So just can have a look at this. Not so important. Now income statement. So income statement basically tells you, how much income you have. You have your net income, which is the bottom line, right? And generally, your net income will result in two things. First of all, it's being used to pay dividends, and then it will result in a retained earnings. Remember, the retained earnings, ending retained earnings equals to beginning retained earnings plus net income minus dividend, right? So your net income kind of is decomposed into amount of dividend paid and how much being retained in the business. So how I like to think about this, right, rather than thinking about formulas, is that at the end of the day, like after you deduct all your expenses and everything, you have a sum of money, and this sum of money is your net income, right? And so with this sum of money, you can imagine you have this sum of money. You can, first of all, either invest it again, like to reinvest the money, and this reinvestment is called retained earnings, or you can say, oh, you know what, I'm going to take some of the money, this sum of money for myself, right? And if you take it for yourself, that is like dividends, right? That's how I like to think about it. So imagine net income as like a lump sum of money that is remaining after deducting all your expenses. And this sum of money can either be reinvested, which will become a retained earnings, or it can be paid to yourself, or you just take a portion of it, right? And that's like dividends. Oh, that's a good question. If net income is, I guess, is it the same as EBITDA? Okay, so I hope all of you can see that question. So EBITDA is earnings before interest, tax, and depreciation. And no, it is not the same as net income. So it's different from NI, because earnings before interest, tax, and depreciation. So this is interest, tax, and depreciation, means that you do not consider interest, tax, and depreciation. And of course, your net income, you include interest, tax, and depreciation. So they are different things. And maybe I'll cover a little. So this is probably not in the not what you need to know, but I think it's a good question. So I'll discuss a little about this. So generally, the problem of why people like to use EBITDA instead of net income is this thing. Can you see that interest, tax, and depreciation, they are not related to ops, the operation of the company, right? So interest is relating to debt, right? How much debt you take. Tax is related to the tax code of the country, right? Whether it's Singapore, are you in US, Canada, right? There are different tax codes. Depreciation is related to what? How much property or how much PPE you buy, right? Vehicle, how many vehicles you buy. So the issue with net income is that net income considers interest, tax, and depreciation. And these are not operating factors that is impacting the bottom line. That is why most companies like to use this concept of EBITDA instead of net income. And that's a good question, right? All right, so this is the income statement. I'll not go through. Okay, maybe we can just take a quick break first. Let me just see how many slides. It's quite a bit more. Okay, let's take a quick break. Let's come back, let's say in 7 minutes, maybe like I don't know, 8:19. Yeah. We'll take a quick break. and I'll see you guys in a bit. As usual, if you have any questions, feel free to type it out in the chat, and we'll answer them in a bit. All right. Hope you have there's a short break, go to the toilet, maybe have some coffee. And yeah, let's continue. So far, we have been talking a bit on the financial statement, and there are two concepts in accounting that is important to consider. Okay, the first concept is called this thing called matching principle. I want to highlight that you need not memorize what's matching principle. You need not even need to know the term for matching principle. So this is more like a background knowledge, but we need to know, because of this concept, why are we doing certain things, right? And we'll see it later in terms of adjustments. So if you want to forget what's a matching principle, go ahead, we don't need to know it, but you need to know the concept of it, all right? So the idea of matching principle, I want to try to explain the concept, is that we need to match the revenue earned for that period with the expenses that's been incurred in that period. What does this mean? It means that in generating the revenue, for example, we need to buy a car, let's say buy a vehicle, right? And this vehicle would have to be depreciated. And because of that, we need to actually do depreciation, let's say per year, to match it to the revenue. That's why our revenue is being decreased by the amount of depreciation. And because of this, because we need to do this matching, that is why we need to include depreciation. And we know that depreciation is a non-cash kind of item. Why? Does it mean, okay, let's say if I'm going to depreciate my car for 3 years, right, in a straight line method, do I really reduce the value of the car? Like in terms of the usage, the mileage, do we actually reduce it by 3 years, and at the end of 3 years, I cannot use the car anymore? No, it's just an accounting concept, right? It's not like at the end of the 3 years, I need to sell the car. No, I can still use the car for the next, let's say, 4 or 5 years, right? But it's an accounting concept, and the accounting concept is based on this idea of matching principle. And so, like I mentioned, finance and accounting are very related, but at the same time, they are not related because accounting is historical. So in terms of finance, later we'll see that we always have to add back. So we need to add back depreciation. Why add back? Is because in the financial statement, when the accountants did a financial statement, they have less of depreciation, meaning that they deduct depreciation, right? Because it's expense. But for us as finance, maybe not majors, but as we learn finance, we need to add it back because depreciation is non-cash. So that's what you need to understand. Next, we have this concept called the accrual basis of accounting. And again, I want to repeat, you don't need to know the name of such principles. They are purely accounting based, but it helps you to understand. All right. So accrual basis of accounting means that you need to record revenue when it's being earned and cash when it's being received. And on the flip side, you need to record expenses when it's incurred and not when it's being paid. Sorry, it's not when cash is received. And this concept of accrual of accounting results in the idea of why a profitable firm can go bankrupt, because you record the revenue when it's earned, but have you actually received the cash yet? No. So that's why this gives you AR, right? Accounts receivable. So you make a sales, but you're not going to get the cash yet. At the same time, when we record expense is when it's being incurred. For example, depreciation, when the depreciation is being incurred, right? But do we actually pay out like the cash for the depreciation? No, right? We don't record it when it's being paid. So in this sense, because of this issue or this concept of accrual basis of accounting, in terms of finance, we are not so interested in accruals, because what we're interested in is cash flows, whether the company is making money. We are, like I say, we are interested in the market value. We want current information, and that is why in finance we will do we'll purely focus a lot on cash flows. And the important thing about cash flows is that the cash flow in the cash flow statement, I believe you probably have seen a cash flow statement, is not the same as the cash flow we talk about in finance. So in finance, our cash flow is we call it incremental cash flow, right? So how much of let's say I buy an asset, right? Asset. How much of this asset would increase the cash flow of the firm? So we are interested in the increments, right? Incremental cash flow. We're not interested in, whatever asset that's already present that's giving you this cash flow. We're not interested in that because we are more interested in, if I buy additional asset, how much more will it increase, right? It's almost the same as why we are interested in decision making when you're talking about finance, because the incremental cash flows is the one that will allow us to understand whether we should buy the, let's say, asset, right? And provide us the decision making tool. Yes, correct. Perfect. You're right. So thanks for that question. So it means that yes, valuing asset, we are interested in their future cash flow. That's perfect. Yeah, that's right. In fact, when we value a firm, we are also interested in the future cash flow of the firm. So later we will talk about valuing firm, and we'll see that we only focus on the future value, and we will have a long discussion about what cash flow to include and what not to include. So I think that's in lecture 4 or 5. So we'll go into detail about that, and that's perfectly right. We're only interested in future cash flows. Okay, this would perhaps be one of the most important slides in today's lecture. Why? Simply because, first of all, there's a lot of information, but not only that, we will use this concept again and again in lecture 3 and 4. All right, so it's important, if you have any question, feel free to stop me and get the fundamentals and the basics there. All right, okay. So like what your classmate had mentioned, we are interested in the future cash flow of the firm. So what we're interested in is the cash flow from assets. So how much cash is being generated by the asset? And obviously this cash generated is new cash flows, right? How much new cash flow is being generated? All right. And we can split this into 3 components. The operating, we have the capital, and then we have the change in net working capital. So remember, net working capital is about operations, right? The capital required for operation. The capital spent is your fixed assets, right? How much of the cash flow is generated by fixed assets? And now this operations, which is how much cash flow is being generated from operations. So we have 3 components here to calculate what is the cash flow from assets. Okay, so we have mentioned cash flow is from operations is from what's the cash being generated from daily operations. We have 3 formulas here. All right, let's tackle the first formula here. Okay, so operating cash flow equals to net income, okay, plus depreciation. So why plus depreciation? Is because depreciation is non-cash. So we need to add back the depreciation, because remember we talked about finance. We're not interested in the matching principle, right? We want to think about what is the current cash that is being available. So we need to add back the non-cash item. Now, why do we add back interest? Okay, so we add back interest because interest is relating not to the operations of the business, right? It's relating to the capital structure. So we are talking about capital structure is relating to whether how much debt or equity is being used. So that's capital structure. So we add back the interest, and this interest is interest expense. I want to emphasize interest expense, EXP. All right. And the other 2 formulas is simple derivation of your first formula. All right, and it is right that there is no more interest in the second formula because it's being absorbed into the EBIT. All right, then you know what? I think it might be useful to show you the derivation of it. Let me just hop to my notes. Okay, let me just put it. Okay, so we have first of all, you don't need to memorize how to derive the formulas. This is just for understanding. All right. Can everyone see this? All right. Operating cash flow equals to net income plus depreciation plus interest. So again, what I'm doing here is I'm trying to derive the second and third formulas to show you that they're exactly the same. All right, using the first formula. So we know that operating cash flow equals to net income, which is sales minus I don't know, costs. Let's say costs minus depreciation minus interest expense plus depreciation plus interest. Wait, I think we need to put text in as well. So multiply, so this must multiply by 1 minus tax plus depreciation plus interest. So what's happening here is this net income is being decomposed into this long component here, right? Okay. After we do this, what's happening is that we can derive the third formula first, where sales minus cost times 1 minus t, 1 minus tax, right? So I'm just going to, and then I'm going to multiply in the 1 minus tax into minus depreciation minus interest, right? So what's happening here now is I will have minus depreciation plus depreciation dt, right? So what I'm doing here is I'm multiplying this one with this one. Next, I'm going to multiply this one with this one again. So minus interest plus interest tax. All right. Let me just put this here, and then I'm going to rewrite this again here. So plus depreciation plus interest, right? So this is just a derivation. So what is happening now? What is going to happen is that, can you see minus depreciation and minus plus depreciation cancels out, and negative minus interest cancel out. So eventually, what do you get? You will get the, okay. So what do you get? You will get sales minus cost 1 minus t plus dt plus it. IT is interest times tax, and dt is depreciation times tax rate. And we derive the third formula. Okay, so the third formula okay, so sorry, I saw a small question. Slides on. Okay, if you okay, so I think some of you all might have some issues with the slides. If you download the slides from our tutorial group, so TO8, that's where you will see these slides. Yeah, let me know if you can't find the slides. Okay, so let me go back to this part. Can you see that dt and this thing here, all right, this thing, they add to this giant I don't know, formula, right? And what does this mean? Your DT and IT, which is depreciation times tax, interest times tax, are shields. SHIELD. They help you shield the cost because you're adding depreciation and adding interest times tax back into your operating cash flow formula. So they kind of act like shields for your operating cash flow because they increase the operating cash flow that you have. So this is a very important concept. These are shields. So we'll go into detail on this shielding effect, I believe in lecture 3, but this is important to take note of. Right, so we have derived this third formula. In terms of the second formula, in terms of the second formula, let me just jump back to the slides. Now, in terms of the second formula, EBIT minus tax plus depreciation. So what is EBIT? So EBIT is earnings before interest and tax, right? So it means sales minus cost minus depreciation, earnings before interest, and before tax. So we don't consider tax. So what is happening is that this plus interest, and then we have minus interest, basically cancel out each other. And because they cancel out each other, that's why your interest here disappears. You no longer see it. All right. I think we have an example here. Okay, let's just go to the example before I explain the other concepts here. So, oh no, this is operating. Yeah, okay, so this operating cash flow. So we want to calculate the operating cash flow for this firm. And in this example, we use the 3 formulas. So, in your assignments, you just use one, which one is preferred, which is the easiest to do. So do not restrict yourself to one particular formula. You can use any one. And again, I repeat, the derivation of it is not important. If you do not know what I've talked about like for the last 5 minutes, it's fine, just forget about it. You just need to know this formula exists and how to use it. All right, and this is how you use it. So operating cash flow equals to net income plus depreciation plus interest, and this is given here. And I show you that all 3 formulas give you the same answer. All right, so you just plug in the figures. I want to highlight again, this is interest expense. So sometimes you might have interest revenue or interest income. We should only use the interest expense amount. All right. Do not use the interest revenue amount. Use interest expense. Okay, so that is operating cash flow. Now let's look at this net capital spent. This net capital spend equation is a bit easier to understand. Why? It's because you just take what's the ending amount of net fixed asset minus the beginning, right? So ending minus beginning plus any depreciation. So that is how much money you actually use to buy the fixed asset. Okay. Why they say net? Net here means that you need to remove away accumulated depreciation. So you need to take the fixed asset amount at historical cost, of course, minus away depreciation, not depreciation, sorry, accumulated depreciation, AD. Right? So that's the net. So this is important. You need to use net. Sometimes the question, they will just give you historical cost and the accumulated depreciation. So you need to net it. You need to remove away accumulated depreciation. And what does NCS stand for? It simply means how much capital is being spent on buying fixed asset. How much money is being spent. Next, let's look at change in, okay, so I'm just erase all this so it's not too messy. So now let's look at what's this change in net working capital. So we know that net working capital is CA minus CL, all right? The thing is, change, what we are looking at is the change. Remember, just now a friend of yours or your classmate mentioned that what we're interested in is incremental cash flow, new cash flow. So we're not interested in working capital, we're interested in the change. So we need to use ending minus beginning net working capital to find the change. And this is very important because usually questions will give you CA, they give you CL, and then they ask you what is the change in net working capital. So we need to take CA minus CL for the ending, CA minus CL for the beginning, and then we minus it off. These are some comments about net working capital, is that if it's too big, sometimes it could mean that there's a build-up of inventory due to slow sales. But generally, positive is good. So we have an example to explain these concepts. So let's look at this. Net capital spent. So this is rather simple. We plug in the values. Again, I want to highlight is the net net fixed asset. All right. Then we add in the depreciation. Depreciation is here, is in the income statement, and your assets are in your balance sheet here. Can you see? Okay. So this is how we calculate. For your net change in working capital, can you see that you need to find what is the ending net working capital first. Ending is CA minus CL, which is what is done here, right? Minus the beginning net working capital, which is again CA minus CL, right? So yeah, we get this. So I want to highlight again, this is change. I put 2 stars here, very important. And then what we do is we just add up, or not add up, but we take the operating cash flow minus the spending that is being used for the capital or fixed assets, and then we minus away the change. So this change is positive change, right? So we minus the positive change. Sometimes the change can be negative, so we will minus is plus, right? That's primary school mathematics, and so we get this amount. The cash flow from assets. Okay, so the question here is negative cash flow from assets bad? Anyone would like give this a try? Is it bad or is it all right? Or it depends? Yeah, I guess that's the best answer. It depends. Yeah, I guess so. The thing is, depends on what now, right? So I like to use the concept of the startup again. So in a startup, right? Of course, we know that in a startup, we need to buy. Let's say you buy a lot of equipment. We need to buy. You need to have a lump sum of working capital, right? And we know that the working capital will start from 0 to this lump sum, right? So the change is a positive change. So our change in net working capital will be a positive and it's a big amount. Our net capital spend might be a big amount because we buy a lot of equipment at the start. And our operating cash flows might be very low because we have not made any sales. We are just starting out. So yes, the CFA might be negative and yeah, it might not be bad. But generally, if the company is stable, it should be positive. So if it's a stable company and it's negative, then it's a bad thing. Okay, before we go to the alternative formula, any questions regarding this very important formula here for CFA? So if there's no questions, what I'd like to highlight here now is that if you notice, these are financial statements, right? But we have actually, what we have done, we have done adjustments. Can you see we have done adjustments? Because in finance, we are interested in operating cash flow, we are interested in NCS, we are interested in net change in working capital, right? So we are utilizing accounting information, but we have done our own adjustments. That's why I mentioned earlier. We in finance, we need to do adjustments to the financial statement. So if you notice again, we are not interested in net income. We're not interested in like, oh, how much profit, bottom line profit the company made. Yes, we are interested in that, but in finance, we're interested more in cash flow. So that's why we have done the adjustments. We add back interest, add back depreciation. All right. Okay, so if we are good, let's carry on to this. So cash flow from assets, this is the alternative formula. So the alternative is that we use this idea of asset equals liability plus owner's equity. And so what the formula says is that, you know what, this owner's equity relates to cash flow from stockholders, liability relates to this cash flow from creditors. And how do we calculate it? We calculate it, cash flow from creditors is interest paid minus new borrowings, net new borrowings. So this is, you need to take the ending amount of borrowings minus the beginning amount of borrowings. All right. So this is net new borrowings. This is important to take note of. The cash flow from stockholders is the dividend paid. So how much dividends being paid out, minus away any net new equity raise. Right. So don't worry, we have example in the next page to illustrate this. All right. So again, we are using the same statement, financial statement. And so we see that interest paid, and again, remember I mentioned net new borrowing. So we take the ending borrowings minus the beginning borrowings to get this. All right. So this is the cash flow from creditors. Now, cash flow from shareholders, we take the dividend paid, which is, can you see here, dividend paid. All right. Minus away the net new equity. So we need to see how much equity is being raised, which is this amount here, right? The equity. And that's how we get the CFA. So we need to know both formulas. Sometimes certain questions might specify, use this format of the formula to calculate CFA. So we need to use it. So that's a good question. What is paid-in surplus? So actually, it's the same thing as common stocks. So it's common stocks and paid-in surpluses. So paid-in surplus is almost okay. So we know that stocks are, there are many types of stocks, right? There are different categories of stocks. So we have the common stocks, and then we have like preferred stocks and all the other, different tiers of stocks. Although nowadays it's not so common because it's very complex to do, but for big companies, they do have that. And that is being captured in this thing called paid-in surplus. So the variety of other kinds of stock types. That's a good question. Yeah. Okay, this is just a summary. I'll not go through it. And yeah, that's we'll move on to the next part. So before we move on, what have we covered so far? So at the start, remember we talked about the agency, right? I think that's the most important concept, agency problem. And then we move on to try to understand more about adjustments of the statement. Adjustments of the statement, a financial statement for the various three components, right? Operating cash flow, NCS, and net change in working capital. So the last component that we like to tackle is more about financial ratios, and this will be extremely important for understanding the statement of the company, and to allow you to try to value the company. Is the company doing well? Is the company not doing too well? And there is this component later I'll talk about, the analysis of the financial statement, that is very critical, especially in terms of your assessment, like, you know, when you do your P&A or even your GBA. The assessment of ratios are very unique in the sense that, okay, I'll explain later, that we need to think about a lot of issues. We cannot just look at the ratios alone. And from past experience, usually the assessment of the ratios is the part that most students will lose marks on, because they did not assess the ratio according to the context. So we'll talk about this in detail as we go along for this last part. Okay, we have a question here. Would you consider convertible debts as part? Yes. So that's a very good question. So past TMAs, there was this question on and it's published, so you can look at the past TMAs and stuff. They have a question on SIA. And if any of y'all are following the issues with SIA, especially in 2020 and 21, for the financial year 2020 and 21, they had a lot of issues, of course. We all know about COVID. We all survived through COVID. So because they had a lot of issues, what they did was that they issued convertible debts. And convertible debts are considered equity. So this is a very tricky thing, because convertible debts are actually like debt instruments. So debt instrument meaning like they're taking a loan. The company, the SIA is taking a loan, right? But because they are convertible, under the accounting rules, they are considered as equity. And because they are being considered as equity, it helped them reduce their debt equity ratio, which is what we're going to talk about in just a bit. What is a debt to equity ratio? Why is it bad? Why is it good? Whether high value is good or high value is bad. But they are very smart, because what they did is that they use convertible debts, and so they reduce their debt amount and park the entire value of convertible debts into equity. And therefore they were able to reduce their debt to equity ratio. And why is it important? Is because, you know, sometimes when you want to take a loan from a bank, the bank will require you to have a certain debt to equity ratio. For example, it cannot exceed 3 times. Like debt divided by equity shouldn't exceed 3, the ratio of 3, right? So what SIA did was that because they used convertible debts, they could reduce this debt to equity ratio, which allowed them to get more borrowings or committed borrowings from the bank. And that's how, I guess, they can, in a sense, I wouldn't consider manipulation, but smart capital structuring of the company. So that's an excellent question. And yes, it can be part of the paid-in surplus. And it really depends on how they, usually they have this thing called a note to financial statement, and then they will detail all the line items that is not shown on the balance sheet. All right, so that's a good segue to the concept of ratios, the debt to equity ratio, and this is what we are going to talk about. All right, and so there are a few main things. First of all, we do standardization. We'll look at this. We'll do some computations. We'll determine the profitability of the firm based on the ratios. All right, so when we do a standardization, we think about it as a common size. So for balance sheet, we always standardize it using total net assets, all right? And when we want to standardize income statement, we standardize it using total sales. And standardization is very simple. We just divide the value. So these are all the values, right? Current asset, cash, all this. We divide it by the total asset, and everything becomes a percentage. as you see here. So see, everything become a percentage. And of course, total asset is 100% because you're dividing by the asset. It's not so important, so I'm just going quickly. So this is the income statement. We know that sales figure is this amount, so we divide everything by total sales. So we get all these are percentage values, all right? Generally, in the market, standardization is not too used. People don't really use it. But what is good about standardization is that sometimes if you want to compare two different companies which vary in terms of sizes. So one company is a very small company or medium-sized company, and one is a big company. For example, we want to compare, let's see what we want to compare. StarHub and Singtel, right? So Singtel obviously is a bigger company. StarHub might be slightly smaller. So if you want to compare StarHub and Singtel, we might want to use a standardization, but nowadays it's not too common because there are better ways to do it, right? Standardization is like a low ranking way to do it. So people use like ratios and stuff we should talk about. Yeah, this is what we are more interested in, ratio analysis. And it's used internally, externally, you know, everything. What I want to highlight here is this thing called context. So this is extremely important for your own knowledge as well, and of course for assessment, like your TMA, GBA, or final exam. When we do ratio analysis, context is super important. So let's look at maybe one ratio so that we can understand what is context. But if there's anything that you should know, you should write this on your iPad or whatever, that context is very important, okay? This is probably the part that if you do a ratio analysis and you don't score well, it's because of context, all right? Okay, so we have a couple of ratios to talk about. Liquidity ratio, we mentioned an idea of liquidity, right? It's about how easy we can sell the products. So cash is the most liquid. But of course, we can use ratios to also analyze the company. Now, financial leverage ratio. Now, this is, the explanation is here, but basically what it means is that, is your company able to run or survive in the long term and pay off interest on debt or meet its debt obligations, right? So the difference between liquidity and financial leverage is that liquidity is about short term, like how fast can you pay immediately the interest, right? Let's say interest. But long-term financial leverage is more like, can you meet the, let's say, maturity when the debt matures? Can you repay the principal? So that is more long-term looking. So that's the difference between liquidity and financial leverage. Asset management. So asset management talks about efficiency. So we'll look at various efficiency related ratios. Profitability, we all know about that, how profitable, and market valuation. This is about valuing a company, right? Any questions so far? We are good. Okay. All right, so this is just a table of the ratios. We'll go into detail. All right, so the part in gray is kind of like some additional comments, but they are not cast in stone, meaning that you can make more comments than this, right? But just give you a rough idea what is the ratio about. Because it's more important to analyze, understand the ratio, rather than, oh, we memorize. Actually, you don't even need to memorize because it's open book exam. But just know current ratio is CA divided by CL. But what does actually CA divided by CL mean, right? So, okay, we are looking at liquidity ratio now. And we see that the first thing we look at is current ratio. Current ratio, you just take CA divided by CL, right? Current asset divided by current liabilities. And what does this mean? It means that how much current assets is available to cover your current liabilities when it's being required. So we are both using current divided by current, meaning that we're looking at liquidity of the company, right? So in this small comment, it says that, it's advisable that companies have more than one. More than one meaning what? You have more than one-to-one kind of current asset to current liabilities to meet its immediate obligation of the company, right? But I want to highlight something that if it's too high, this is a big issue as well. Why? Because current asset includes things like cash, right? If your cash or let's say inventory is very big, first of all, if cash is very big, means that what? You're not investing your cash well, right? Because cash, you should invest it in, like, I don't know, stocks, bonds, or whatever, right? You should have long-term investments so that it gives you high returns compared to, even for yourself, right? If you have cash, you put it in the current account, you know that you don't get a lot of interest, right? You will put in fixed deposit, you put in various instruments. So first thing, too high means that you might have too much cash. It's not good. Now, you might have too much inventory. It's also not good, right? Because inventory can become obsolete. It can be, a new model of iPhone is out, the old model is no longer wanted, right? So too much inventory is not too good as well. Again, current asset could include accounts receivable, right? Accounts receivable, if it's so big, means what? It means that a lot of your customers owes you money, right? That's how accounts receivable. They owe you money. And because they owe you money, chances are some of them might default on payment. They might not pay you. So it's not good as well, right? To have such big or large amount of accounts receivable. So in general, too high is not good. So if you calculate a company that has like the ratio of 3, no, it's not good. Now the question is, how high is high? How low is low, right? I think perhaps that you might be thinking of that. So the best way is to always compare to the industry averages. So industry average. So in this particular industry, what is the average? Is the company above the average or below the average? Now, quick ratio, same as current ratio, just that we minus inventory, because inventory cannot be converted to cash without a fire sales or discount. So we are being even more stricter. So we only consider cash or accounts receivable, right? Now, cash ratio is super strict. You only consider cash, cash of the company. Do you have any questions regarding this? Okay, so maybe before we move on to the other ratios, the leverage ratio, again, I want to repeat, like, in terms of the intuition, like, yes, all these ratios, you will need to know how to calculate them, right? Like in your assessment, you need to know how to calculate them and pick the numbers out, right? But what's more important is to understand the meaning of the ratio and be able to explain. So, I mean, in a typical kind of assessment, usually the calculation is like what, maybe 3 marks, 2 marks, right? But explanation, that is where it's like 5 marks or 8 marks, right? That's where the main bulk is. So, because nowadays in the if you are working in the finance industry, the ratios are actually calculated for you. The computer does the job, right? I think maybe some of you all might be interested in AI and all those things, right? You don't even need AI to do that. Like, you just need a simple Excel. They do everything for you. So calculating ratios have very little value add in the industry, or even your employee. They don't really bother so much, right? Your employer, they don't really care so much whether you can calculate ratios. But what I guess robot cannot do, maybe now they can with ChatGPT, but what most robot cannot do is to analyze the ratio in the context of the company and in the context of the economy. And that's where your value add comes in. And that's why that's important. All right. So think about the value add that you have when, so calculating is like, primary school, you probably can calculate it already. So what is your value add here? And that's what's important. That's why I want to highlight the meaning of the ratios. Okay, so we have this, so now we move on to financial leverage. So financial leverage is we'll look at a few ratios, and we'll notice that most of them deal with debt, because remember, financial leverage is about the long-term survival of the company. So we have this thing called debt, total debt ratio, which we just take, what is the total amount of debt, which is total asset minus total liability divided by total asset. So what does this mean, right? It means that is the percentage of the company's asset which is financed by debt. So how much of the asset is attributable to debt? The debt to equity ratio, this is even more common that's in use in the industry. You just take total amount of debt divided by equity, right? So what is the percentage of debt to equity? This gives you the capital structure of the company. Equity multiplier, this is just another ratio. Basically, you just take 1 plus the debt to equity ratio, equity multiplier. It tells you the portion of the company's asset that is financed by equity rather than debt. Yeah, gearing, yes, correct. So some of you all might know this term called gearing ratio is, it's the same, as a debt to equity. I want to highlight to you that if you notice the calculations here, total debt is, they take this total debt here, long-term debt, plus this current liabilities, right, in this format here, divided by this. So I want you to take note that under the total current liabilities of the amount 540, which is here, it includes accounts payable of 344. So this is just for you to take note that generally accounts payable are not considered debt. All right. So why is it calculated this way? Is because the textbook that we are following use this method. But in the industry, if you talk to any accountants, they will tell you that accounts payable are not debt because they relate to the working capital. Remember working capital, CA minus CL. So they relate to the working capital of the firm. So just want to highlight that the true debt equity ratio should exclude accounts payable. So the question is, in assessment, in your assignment, should you include accounts payable? Should you not include accounts payable? But what I've checked is that both answers will be accepted. So you shouldn't worry too much. Okay, financial leverage, we do have other ratios, time interest. So this says the EBIT divided by interest. Basically, is saying, is the company able to service its debt obligations based on the income it generates? So this is the time interest. Now, the cash coverage is also the same as time interest, but you add back depreciation because depreciation is a non-cash item. Right. Okay, so we have some asset management or efficiency ratio, which I like to call it. We have 3 main efficiency ratios that we'll talk about. First is the inventory ratio. The inventory ratio, first of all, we always calculate the inventory turnover, right, which is cost of goods sold divided by average inventory. Okay, so again, I always like to highlight the important things that you should take note of. And this is one important one, average inventory. Okay, what does average mean? Average means let's say if we are calculating this ratio for 2022, okay? We are calculating the inventory turnover for 2022. The average inventory means that you need inventory of 2021 plus inventory of 2022 divided by 2. This is how we calculate average inventory. All right, for this figure, and then to calculate the inventory turnover for 2022, we just take this cost of goods sold for 2022 divided by the average inventory. And then maybe your question is, oh, wait, but then the calculations did not do that. Yes, the calculations did not do that because in this example, they only give you 1 year of information. So the bottom line is that if the question gives you 1 year only, you don't have information on the last year's inventory, so you just use that year's inventory. But if the question gives you 2 years of information, you must use average inventory. I repeat, you must. If you do not, you will probably lose half the mark, or not half the mark, maybe lose 2 or 3 marks, right? You need to use average inventory. So I want to highlight, you must use it if the question gives you 2 years. And so the thing is, they're asking, so inventory turnover tells you how many times the warehouse is being emptied, and it shows how efficient, right? That's why it's called efficiency ratio, how efficient your inventory is. There is this thing called inventory period or days sales in inventory. Simply, we just take 365 divided by inventory turnover, and we get the value here. It tells you how long the inventory sits on the shelf before it's being sold. If you do Google sometimes these days sales in inventory, I like to highlight that some of the formulas, they might use this 360 divided by inventory turnover, IT, right? So sometimes you might see 360, sometimes 365. Try to use 365 because that is being taught in class. Although 360 is not wrong in the market, because generally in the finance industry, we like use 360 because it's dividable by 12, right? It's easy to divide. 365 gives you a weird number when you divide by 12. So try to use 3. But use 365, right? But if you see 360, don't be alarmed because it's possible too. Okay, so that's for inventory. We have another, again, it's the same thing, the turnover ratios, but now this is regarding receivable turnover. Again, I want to highlight this average AR. So you need to take this year divided by plus last year divided by 2. But there's one more thing I want to highlight you. Credit sales. Okay, this is very important. You only include credit sales and not cash sales. So I'm just going to write here. So cash, no. Credit, yes. So why? Because credit sales relates to receivables, right? Because you do a credit sales, you are supposed to receive money, right? So you have a receivable. And that's why we only consider credit. When you have a cash sales, you simply get the cash. We have no receivable. So it has no impact on your receivable turnover. So when you read the question, be very careful. Sometimes they will try to trick you. They say, cash sales is this, credit sales is this, total sales is this. So don't simply just use the total sales. Look at the question and remember that only credit sales is considered. If not, the rest are the same, the formulas are the same. Not too exciting. Okay, so the last efficiency ratio is your payables ratio. So remember we have inventory, we talk about receivables, and now we have your payables. So payables, again, the same thing, cost of goods sold, but now so divide by average, and then we use the same formulation. So what it means is that it tells you how long it takes you to pay your suppliers. Okay, so I have a question. For payable, let's say payable period, do you prefer it to be longer or do you prefer it to be shorter? Okay, actually, Yeah, very good. Okay, that's good. Initial, I think, yeah, longer. Yeah. So longer is correct. That's good. I'm glad you changed your answer. So the answer is longer. Why? It's because it take, okay, so we go back to the understanding. Payable ratio is how long you take to pay your suppliers, right? So as a company, I want to drag my payment as long as possible, right? I don't want to pay my suppliers so fast. Because it's almost like a loan, right? I'm getting a free loan from my suppliers. That's how you can think about it. I don't want to pay my suppliers. I want to drag it as long as possible. And so because of that, payable ratio or payable period, the longer the better. Now, the reverse is true for receivable ratio. So for receivable ratio, we want it to be as fast as possible. We want to get the money from our customer as fast as possible. So shorter is better. Yeah, correct. So receive cash you want fast, pay cash slow. So it's a bit asymmetrical, I would say. It's unfair, right? Like everyone wants that. So that's why there is this tension. You want to pay cash slowly, so payable ratio is very long, but your receivable ratio you want to be as short. You want to force your customer to pay. So yeah, so that's important to take note of. So we need to know which one is better. Of course, inventory turnover. Okay, so for inventory turnover, what is good, what is bad, depends on the sector. That's where context come in. Like I mentioned earlier, context. So, for example, a supermarket company, or not company, so a supermarket would want a short inventory turnover, right? Because things should go very fast because they're perishable. But for example, a car manufacturing company generally have very slow inventory turnover. You don't see them selling cars, 10 or 20 cars every day, right? It is usually a big ticket item. People don't change car every year, right? So it depends on the sector for inventory turnover. Yeah. So for petrol, yes, there's high turnover, especially if the number of cars increase. So asset turnover ratio. So total asset turnover, again, is a efficiency ratio. Basically, we just see, how efficient your asset is in generating sales. So we take the sales, divide by total asset. So how efficient. Capital intensity ratio, we flip the asset turnover. So we just take total asset divided by total sales, is how much capital is needed to generate per dollar of sales. So we just flip. Okay, so profitability ratio, this is perhaps the easiest to understand because then most of you all might have already seen something similar. So profit margin, you just take net profit divided by sales. Gross profit is the cost of goods sold, or sales minus cost of goods sold divided by sales. And what's important is that the gross profit margin tells you the pricing power. This concept of pricing power is important. Why? Because we need to think of data we just mentioned a bit on the Porter's forces. Porter's six forces. I think it's 6 forces, right? I hope everyone heard of these Porter's forces? Porter's, maybe in your strategic management course. Oh, Porter's 5 forces. Yeah, 5. Yeah, I think it's 5. Yes, you're right. Porter's 5 forces, not 6. SWOT. Yes, SWOT is another way to do it, but Porter's is good because Porter's talk about the bargaining power, right? Bargaining power of suppliers, bargaining power of customers. So your gross margin actually captures the bargaining power. So we'll talk a little about that in a bit, especially when you do analysis of financial ratios. We need to consider what is the bargaining power. And that's why usually, for me, I like to use either the SWOT or the Porter's to analyze this. EBIT margin. So EBIT margin is generally used to isolate ops, so operating function, because it is the earnings before interest and tax. And remember, just now one of your classmates talk about EBIT, interest before interest and tax. Wait, so it's interest EBITDA. Sorry, DA. Yeah, so basically interest before interest, sorry, earnings before interest, tax, and depreciation. And A is amortization. So why we do not include these things? Because these are not related to operating, not ops, because they are relating to the interest, the debt structure, the the tax jurisdiction, and depreciation is related to capex. So EBIT margin usually is being used. So here again, they mentioned this. So this large chunk of text, basically what it's telling you is that operating margin focuses on purely the operations, because sometimes the company can receive other kind of income, for example, interest income. So interest income from giving out loans. So interest income, if the company's job is not about giving loans, they're not a bank, they might have interest income, and these are not part of the assessment of the efficiency of the company. So that's why usually they use operating margin or EBIT, right? Yes, so capital gain. Now, capital gain is a bit tricky. Why? Because capital gain, it depends on what capital you're talking about. If it's a PPE meaning fixed asset, so this is a bit more technical. Again, I want to, before I carry on, I would like to say, if you're it's not covered in the syllabus, you can, if you don't know about it, don't worry, forget about what I'm saying. But if you're interested, I'm just going to highlight a little about this capital gain. So capital gain, if it's a PPE, the gain will be recognized in the P&L, right? Profit and loss statement. Now, the thing about other types of capital gain, for example, if it was a revaluation gain, meaning that you revalue your assets, it could be included in the income statement, or it might be included in this thing called the OCI, other comprehensive income. And the OCI statement is basically after your net income, and then after net income, there'll be some other plus, minus, and these values will give you finally a OCI. They call it OCI. And this plus, minus includes things like your revaluation gain, translation gain, or unrealized trading gains. So all these gains, they are considered capital gains, but they are not included in your net income. All right, they're considered other comprehensive income. And so generally we don't even care about it. Like we don't even consider all the statements that's below here. Right. So again, this is not covered in your syllabus, just for your own information. So yeah, capital gains can or cannot be included. So just be very careful that it's not included across the board. That depends on what capital is it. Okay, so there are some other profitability ratios. You have your return on asset, return on equity. So we just take what's your net income divided by total asset, net income divided by equity. So return on equity is perhaps the most important profitability ratio that is usually calculated, simply because of the goal of the corp, right? And remember, the goal of the corp is about maximizing share value, and that's related to equity holders, right? And not market share. So market share is so I'm just going to put a big cross here. It's not about market share. The goal of a corporation is about share value. That's why we consider the return to equity, or return on equity. So what's interesting to take note is that, remember I mentioned about this thing about SIA and how they use convertible shares. So when we have such cases, basically your equity is being manipulated, I mean, it's being changed and it's not reflecting the full value. And so we need to consider such issues when we think about the analysis. And generally, if we use more debt, um, your equity percentage is lower. But it doesn't mean that our return on equity is always better if you use more debt, because remember, if we have more debt means TE is lesser, right? And then if your denominator is lesser, means that your value, your ROE is bigger. Now that's not always the case, because we have one more issue on, we have the numerator, which is net income. And net income includes what? This net income includes interest. And so if we have more debt, we have more interest. And more interest will impact our ROE figure, right? So ROE, if there's more debt, ROE will be higher if it is in a boom or normal economy. Means that if it's doing well. But in a bear economy, ROE will be lower. Okay. Okay, maybe we just take a quick 5 minutes break now. We'll come back at maybe 9:30 when we continue the rest of the ratios. Let's do a quick break. All right, welcome back. Okay, we have the last part of the last few ratios, and the last part, last 3 minutes. Okay, so let's carry on. We will move on to the market valuation ratios, and these ratios are used for market valuation, but it's very hard to really analyze the company simply based on these ratios, right? And we'll see why. But the most used is this thing called earning per share. It basically gives you you take what is the earnings divided by the number of shares, right? So we can calculate earnings per share. Basically, it shows you how much the investor is willing to pay for $1 of earnings, right? So if it's negative, so if earnings is negative, obviously there's no earnings now. We can't use earnings. So we need to use this PS ratio, which is price per share. We take the price per share divided by sales per share, right? Generally, for earnings per share, sorry, not earnings per share. This is PE. So PE ratio. Sorry. For PE ratio, generally the higher the PE ratio, means that what the price per share is more than the earnings per share. Means that the market is valuing the company more than the intrinsic value of the company. Okay, why do I say intrinsic value of the company? So just now, a classmate of yours asked about intrinsic value, right? So intrinsic value generally relates to the valuation of the company, and they relates to the earnings, right? Because earnings are historical data, and therefore this relates to the intrinsic value. Price, on the other hand, is a market data, right? So if the price is bigger than the earnings per share, means that the stock is being overvalued, or the investors think that the company share price or the company's fundamentals will improve over time. That's why they give a higher valuation. That's the meaning of PE ratio, price earning ratio. Like I said, there are a lot of issues with this kind of using this kind of ratios, PE and PS. So why? Because if you notice, price per share, this thing PS is a market indicator, right? It's a market value. Now, EPS, earnings, it is an accounting number. So we are taking a market number divided by accounting number. In technical terms, it does not really make sense. We are taking like apple divided by pear. So there are a lot of critics about using such ratio, even though it's still used quite widely in the market because it's easy to understand. Market to book ratio. So again, it falls trapped into taking a market number divided by accounting number. Nevertheless, we can do it. We just take the price per share, which is we found earlier, divided by book value per share. So how do we calculate book value per share? We take the total equity divided by number of shares outstanding, and then we find this number here. Generally, if price per share is bigger than book value per share, the share is overvalued, and maybe we should sell this share, right? People like to buy an undervalued share so that they can hold the stock, and the stock will improve in performance over time, and therefore they can make a profit. Of course, if the price per share is more than book value per share, it could be that the investor is betting on whether the company will improve in the future. All right, any questions regarding market ratios? So market ratios, are a bit tricky to analyze, simply because when we analyze market ratio, we should have an opinion about the market first before we analyze the ratios. And sometimes a bit, we need to have like an idea, oh, what kind of investor am I? Do I want to hold the share for long term, or am I like a trader? You keep on trading the share. So yeah, usually you have to have a view of the market before we analyze the ratio, which is what we can see here. We can analyze the ratio in two different ways. Okay, the DuPont analysis. Okay, we have a question here. I got confused. Oh, net book value is a very different concept. That is, net book value is an accounting concept. So let's see the market to book ratio. So market to book ratio, we are looking at book meaning the, okay, I guess in this sense, book refers to more the accounting numbers, right? And in this concept, the book value is the total equity, because we are looking at the market value range, market value measures. And it is not like the book value of asset, which is slightly different. All right, hope I answered that question. So DuPont analysis, basically at the end of the day, is decomposing your ROE. So whenever we do a DuPont analysis, the concept or the bird's eye view kind of concept on DuPont analysis is you want to determine which category, 1, 2, or 3, is driving your ROE figure. That's why we split your DuPont into the profit margin, asset turnover, and leverage ratio, right? That's the purpose of DuPont analysis. And so if you're being asked to do a DuPont analysis, you can do the calculations like this, but what's important is that you need to explain how each component, 1, 2, 3, impacts the ROE. That's the purpose of a DuPont analysis. So I have provided some information about what is being calculated here, and what is being measured. So you just have a look at this. We have already talked about profit margin, the total asset turnover, and the equity multiplier. So this is an example of DuPont analysis. It's a good way to analyze ROE, I would say. Okay, so we have this concept of the growth. So there are a few ways that a company can grow. The first way is by reinvesting the money, right, that they have in the company. Or they can take on more debts or issue more shares so that they have more money in the company to grow. Now, when we think about the sustainable growth rate, this growth rate is how the company can grow without taking on debt or issue more equity. That's the sustainable growth rate. And this concept of sustainable growth rate, G, is equals to ROE times the retention rate. So retention rate, right, I give you the concept that retention is basically how much money is being kept in the company. And this means it's 1 minus dividend payout, which is dividend divided by net income, or dividend per share divided by earnings per share. So 1 minus how much dividend is being paid out is the amount that is retained in the company, and we take ROE times the retention rate to give you your sustainable growth rate, G. And this G is an important concept because this G will be used later in, actually it's the next lecture, next week, to calculate various growth factor, all right? So this is a sustainable growth rate here. All right, so this is just some formulas, not too important. Why evaluate financial statement? You can have a look at it, not too important. Okay, so benchmarking, basically, usually when we do ratio analysis, we look at time trend analysis. So how the ratio changes over time. And we compare it with industry average. So we compare with similar industry or this thing called industry average, averages. And then generally industry averages are found on platforms like Bloomberg or even FactSet, which I believe all you have access. FactSet is amazing. And S&P is found there as well. So industry averages. Okay, now there's this large slide on credit analysis. So this is more of a summary of how you should craft a credit analysis based on ratios. And these are very important points. As I mentioned, most of the time in the assessment, you lose marks because of the analysis that is not done in detail, right? Calculations are usually fine because calculating the ratios are easy, but the analysis is tough. So when we do an analysis, what we have to focus on is that we look at the items. Let's say if the analysis asks you, oh, do analysis on the profitability or do the analysis on the balance sheet. And it's very broad. We don't know which ratio or which item we should do analysis on, right? So focus on the item that has the largest on, let's say, the balance sheet, or has the largest change, right? For example, maybe the company sold a PPE and therefore there's a large change. So we should analyze that component, right? Focus also on the ratios that is important for the industry. So this one needs a bit of experience. If you read like credit analysis reports, it says that, for example, in a manufacturing company, we need to definitely analyze like the inventory turnover. We need to analyze the payables turnover and receivables turnover, right? But let's say if you're analyzing a company like a tech company, no, maybe we don't need to care too much about that, about the turnovers, because a tech company will not have much turnover, right? So we need to focus on things that are important for that particular industry. We also need to consider the industry impact, economic impact on the various ratios. So this is the idea of bringing in the context into your analysis. In particular, I want to highlight the use of the Porter's 5 forces or the SWOT analysis. So sometimes, right, the questions will not say, okay, do a SWOT analysis, because they expect you to already know what's a SWOT analysis, have done it before, or Porter's 5 forces analysis. They will not ask you to do that. But in the back of your mind, before even drafting your credit analysis or your ratio analysis, you need to have already done a Porter's 5 or SWOT analysis at the back. And we'll look at an example in a little bit, so that you are able to identify the various factors that's actually impacting the ratios. And that's where we bring in context into your analysis. All right. So if you just say, for example, now that we have covered the ratios, if we just say that, oh, current ratio is increasing from 1.3 to 1.5. And this is a good thing, right? Because there's more current assets compared to current liabilities. If you say that, probably you will not get the full marks. Why? Because, yeah, I mean, anyone can see that an increase in the current ratio is a good thing. But the thing is, what is actually causing the increase? So maybe you can say that, oh, the increase is caused by the issuance of new shares, resulting in an increase in cash. So when you say the issuance of new shares resulting in increase in cash, this brings in the context already, right? And if you go even further, if you have done a good Porter's 5 analysis or SWOT analysis, you might know that maybe the company is preparing to weather, let's say, the pandemic, right? So they're trying to get more cash so that they are more liquid. So they're trying to weather the pandemic. So that's why they issued more shares in that sense. So this is what I'm trying to say about bringing the context into your ratio analysis, which is more important than just I just take CA divided by CL. That's all. That, I mean, like I say, the computer can do it for you. You use Excel sheet. Nowadays, they have templates where you just plug in the figures, they just generate the answers for you. So the computer can do that. But what the computer can't do is providing the analysis. So this is what you have to do, right? To provide the analysis. Okay, so sometimes there's this thing called one-off exceptional items or like black swan events like COVID. So when we have one-off exceptional items, and I think one of your classmates mentioned about, let's say, gains, right? Some gains are exceptional. So you need to remove the gains from the revenue sometimes, right? So you need to read the case, the context very carefully. If it's like a gain that will only happen once and stop, yeah, like GameStop, that's correct, yeah. When the price of GameStop go crazy, right? It only happen once, and then should you include this large gain in terms of your net income? Maybe not, because they might not be recurring. So what's important is recurring, because when we're interested in ratios, right, especially if we analyze ratios across time, the underlying assumption is that these ratios will continue to recur, right? So if it doesn't recur, we should not consider it. Any questions on this credit analysis? This is very important because this would guide you in terms of how you draft your answers for ratio analysis, and the idea of context is really important. Okay, maybe there's no questions. Now, if there is a part D, I'm just going to scroll. If you're using the consolidated slides all the way at the back, just give me a moment. So there's an example here all the way at the back. Now, this is the example, this case study example. So if you're using a consolidated slides is 507. If not, if you're using the individual sets, it's part D. Basically, this is I would say a good analysis of a company. I believe you'll never be asked to draft a full analysis like this, but this will give you ideas of how you should craft your wordings. Because what I noticed is that the last few times that I've taught the module is that most of the students struggle in the analysis part and bring in context. So this is a good example that I'd like to show you. And you can, if you are free, feel free to read. And when you do your assignments, you can refer to this like example of how do you answer the question, right? I will not go into detail to every part, but what to highlight here is, for example, so we first need to understand what is the company about, right? Then we can do our context analysis. And in this example, we use the idea of a SWOT analysis, all right? We talk about what is good in the company. So this basically is a manufacturing company, and they focus a lot of growth in the Chinese market. And so in the Chinese market in the year 2019, I believe, to 2020, of course, there was the COVID-19 that happened, right? There was also some trade issues between China and the US, which could impact the company's valuation or even trade suppliers. So these are some economic factors that we need to consider when we do our analysis. So if you notice, as of now, we have not done our analysis yet, but we are still doing like the background analysis, right? The SWOT analysis, the opportunities. Yes, there might be some opportunities. Here, we talk about some competitive advantages that this company has, right? So we have identified some things. Of course, we have talked about coronavirus or COVID-19. virus. So these are various contexts that we have to bring into our analysis. And again, I'll repeat that usually questions will not explicitly ask you do a SWOT analysis, but this is kind of expected that you have done this, at least in the back of mind. Comparative advantages. So sometimes I like to use the Porter's 5 forces because it brings in the idea of bargaining power and competitive advantages in the framework. But if you use SWOT analysis, it doesn't. So you need to do a separate comparative advantage analysis. All right. Okay. So once we have done that, then we have these financial statement adjustments. Remember, I talked about various adjustments that might not recur, right? And then a classmate of yours mentioned about gains, right? Disposal gains. So disposal gains might not occur. And sometimes we have the operating leases that we need to capitalize, all right? This is a bit technical. Don't worry about this. It's not part of your syllabus, but we need to, if you know what's operating leases, because operating leases are expenses, and therefore we need to capitalize it to so-called an asset or like a liability, right? Not asset, it's a liability. Actually, liability and asset. So yeah, but this is a bit technical, so don't worry about it. But we need to know about this thing about recurring or non-recurring, right? So for example, gains on disposal are non-recurring, so we need to remove the gains from our net income or EBIT figure. We have a peer selection here. What is peer selection? It means that we want to compare with a peer or an industry average. So which is what we talk about, right? So if you don't have industry average, you can compare it with a close peer. Okay, now finally comes the statement analysis. So this is I'll not go through them, but hopefully you have some time when you do a revision of this lecture to just read through how is the analysis being crafted, the way the language that's being used, because this is important. So we see that in this analysis, we try to find what is the contributors of the revenue. All right. Then we talk about the gross profit margins and how is it superior. So this gives you a bit of the idea of bargaining power. All right. We can use the term bargaining power, that'll be good as well. Let's see. So we have done some adjustments to the non-recurring portions here. Let's see what else to highlight. And then we talked a bit about on the balance sheet, we talked about borrowings. So this company has no borrowings, which is pretty good. And then we speak about the debt, gross gearing. So just now somebody mentioned about gearing, right? So gearing is like debt to equity. When we talk about debt to asset as remain acceptable. So can't explain why. Let's see. What else to do? So here, can you see that we have talked also about the payables, the payables component. Here, operating efficiency. So this is, remember your efficiency ratios that we mentioned about the cycle. So this one we use the cash conversion cycle. You have not learned this, but we will talk about this in the last lecture, so don't worry too much. But we need to mention a bit about the efficiency, what's the average credit period, ROA, and stuff, right? So, and then we have the analysis for cash flow, which is not important for us. Okay. Yes, and then we have the various valuation. So we talk about valuation ratios as well. So there are various ways to evaluate. Again, I'd like to highlight that valuation ratios are very difficult to truly evaluate a company, and there are various very complex way to do it. This way is called a football field method, which is a bit complex. Don't worry too much. Whatever that is not covered in the lecture, you don't really have to care about it. Okay. All right, so actually that's all for this case study. So basically this, why I put this case study in is because it allows you to have some reference into how you draft analysis, because I feel that drafting analysis can be quite difficult if you have no background, like, oh, how do I even comment about some certain things? So in case you have some issues, like you're not too sure, fall back on this way of analyzing the company, doing the SWOT analysis at the back. You need not write it down, but at the same time, kind of analyzing the company in terms of the method or the structure that is being done, something like this. So you see profit margin improve year on year, etc. So this is a good reference document, right? Okay, so actually that's all I have. Do we have any questions regarding the lecture so far? Let me just jump back to where we end off. So we'll not cover, I think in the announcement I did mention that maybe we'll cover lecture 2, but I guess we'll not. We'll just do it next week. Any questions about ratio analysis? So ratio analysis is very important, and we should be, yeah, this is very important. Yeah. Any questions, any feedback? Do you think it's too fast? Do you prefer it to be slower, or no break? Or break is too long? Okay, so when I talk about SWOT analysis, so as in don't do the SWOT analysis in your assignment. Like let's say your assignment asks you to do a ratio analysis, you don't have to write the SWOT analysis out. So SWOT analysis is done on the side. That means you don't even write the SWOT analysis as part of your answer. But what's the purpose of the SWOT analysis actually, or Porter's 5 forces analysis, is to allow you to come up with various contexts that will impact your answering of the ratios. Yeah. So you don't have to do, or sometimes if you are very familiar with ratio analysis, you might not even want to do a SWOT analysis because you are very familiar with, let's say, the industry. You know what's happening around, and you don't even have to do it. So it's optional. But I like to usually refer, like if you are drafting the ratio analysis for the first time in your career, then it's good to have some foundation in terms of understanding the SWOT analysis, or the company in terms of SWOT analysis. So, if you are very familiar with the let's say, type of company, the industry, you might not even need to do it, right? Sometimes you are so familiar, you already know what's happening in the industry. You know that, for example, SIA was facing a very bad issue with COVID. You know that they have the issues on convertible bonds, which requires equity. We know about some right issuance, share issuance that actually impact the various cash flow. So if you already have the context, we don't have to talk about it. You don't have to do a SWOT analysis. Maybe just one last thing I highlight, like for the SIA, it was a unique case because they issued a lot of shares. And when you issue shares, your liquidity goes crazy, like you have a lot of cash. So let's say, right, in analysis, you say that, the cash ratio increased exponentially, and it's good for the firm because there's more cash now, right? But if you just stop at there, you will not be able to get the full marks. Why? Because you need to bring in a context that, actually the increase in cash is because they issue more shares. And this is to weather the COVID-19 pandemic. So that's the purpose of this. Basically, now you're bringing the context and you're bringing in the reason why there was increasing cash. That's actually relating to share issuance. Okay, so very good question. Industry averages, they are actually found in FactSet. So I'm not sure any of y'all have started using FactSet. So I know that all of you have access to FactSet. So FactSet is like Bloomberg, just that it allows remote access, because Bloomberg is a bit annoying. You can only access Bloomberg on a Bloomberg terminal. So industry averages are found in FactSet. All right, so I guess we are out of time. Just before you leave, just want to remind you to send in your GBA groupings. Today, latest tomorrow. If not, we'll just be randomly located a group. And yeah, thank you for today. Hope guys enjoy the lesson. We'll meet again, I guess, next Monday. Have a great evening. Yeah. Have a good night. Thank you. Yeah, have a great day. Yeah, it's morning here.